Welcome to Y News, I am Christopher. If the U.S. debt ceiling is not raised, the U.S. is really going to collapse. On May 13, local time, U.S. Secretary of the Treasury Yellen again said that seeking to raise the U.S. debt ceiling is more difficult than ever. This shows that the dispute between the two parties of the United States for the debt ceiling is already white-hot, and the United States wants the debt default, will also seriously affect the United States and the world economy. The International Monetary Fund warned on the 11th, the United States, if a debt default, will have a serious impact on the U.S. economy and drag the global economy. The current multinational economy has been hurt by the U.S. interest rate hikes, making future global economic growth in adverse expectations. Faced with the risk of a U.S. or imminent default, the latest statement released by the U.S. Treasury Department the week of May 13 said that as of May 10, only $88 billion remained for special measures to pay federal government bills, compared to a balance of about $110 billion a week ago. In other words, if the debt ceiling is not lifted or passed when the $88 billion is depleted, the U.S. may default on its obligations, as U.S. Treasury Secretary Janet Yellen predicted. Yellen said, "If Congress doesn't do this, it really hurts our credit rating. We would have to default on some of our obligations, whether it's the U.S. Treasury or payments to Social Security recipients, something the United States hasn't done since 1789. We shouldn't start now. So we haven't discussed what to do." Back on April 26, the U.S. House of Representatives passed a Republican-sponsored bill that would require the government to cut federal spending by $4.5 trillion over the next 10 years and eliminate some clean energy tax breaks, among other things. Under this premise, Congress will approve a $1.5 trillion increase in the debt ceiling. But for the Republican Party proposed this bill is obviously in, the Democratic Party-led Biden administration, such a relevant bill, is a serious compression of the U.S. federal government's fiscal spending, which will have a significant impact on the U.S. global hegemony and the U.S. Democratic Party-related interest groups. Of course, for the Democratic Party side is certainly concerned about the latter. After all, such a reduction policy directly related to the development of clean energy direction. In this regard, the New York Times reports that the Republican bill on the debt ceiling is blatantly self-serving. It calls for further tilting energy policy toward fossil fuels, accelerating leasing and permitting for oil and gas drilling, and reducing barriers to building new pipelines. In fact, for the U.S. Republican Party, they are the representatives of traditional energy interests. They prefer the U.S. government to tilt more industrial policy to traditional energy. This will allow the U.S. traditional energy industry to gain more government support, thus allowing them to gain more benefits. To put it bluntly, both parties in the United States are fighting for the interests of the Democratic Party and the Republican Party for raising the debt ceiling are well aware of it, only that they want to get more benefits for themselves. In order to expand the energy market, the United States is busy solving the debt problem while planning to sanction Russian energy. Since the outbreak of the Russia-Ukraine conflict, the US-led West has imposed 10 rounds of sanctions on Russia and is currently brewing an 11th round. The latest news is that the West will prevent Russia from restarting gas exports from pipelines to European countries. The Financial Times reported on May 14, citing officials involved in the negotiations, that the EU and G7 countries will ban gas imports on the disrupted Russian gas pipeline, which would be the first time since the outbreak of the Russia-Ukraine conflict that the West has blocked pipeline gas trade. The decision will be finalized at next week's G7 Hiroshima summit, the report said. 15 months after the outbreak of the Russia-Ukraine conflict, the West hopes to continue to curb Russia's energy revenues and intensify the pressure on its economy. One official said the move would ensure that countries involved in the sanctions would not change their minds in the future. European gas imports from Russia plummeted in the middle of last year as a result of Western sanctions against the country, causing local gas prices to soar to more than 10 times normal levels at one point. To safeguard energy security, EU member states agreed for the first time last year to voluntarily reduce gas demand from August 1 of the same year, and continue to do so today. In addition to cutting demand, European countries have accelerated the promotion of renewable energy sources and are working to find alternative supplies, such as expanding imports from Middle Eastern and North African countries, thereby reducing the share of Russian gas from more than 40% to less than 10%. In addition to this, warm winters have mitigated the use of natural gas. Combined, these factors have led to significantly lower gas prices in Europe, where overall gas reserves have reached about 60%, well above the 30% at the same time last year, a figure that EU officials say will reach rated reserves by the time the next winter arrives. Gas storage in Europe is very high at this time of year, so wholesale prices have fallen back to levels that might be considered in the normal range, which is why European leaders believe the plan won't disrupt supply security anytime soon, said Tom Marzek-Manser, an analyst at energy consulting firm ICIS. However, it's important not to get too complacent about the outlook for the European gas market.